On February 9, 2026, a Bloomberg headline moves across global bond desks. China's regulators have directed major domestic banks to curb, some to halt, new purchases of U.S. Treasury debt. $298 billion in dollar-denominated bonds sits on Chinese bank balance sheets as of September 2025. And the message is simple. That exposure is now treated as a concentration risk. In the same trading session, the U.S. dollar drops nearly 1%, and yields are forced to price a world where the marginal buyer is no longer guaranteed. And if you are a homeowner, a buyer, or anyone financing life through a mortgage in 2026, this changes everything. What if everything you believed about safe demand for U.S. Treasuries was wrong? The shock is not the headline itself. The shock is what it reveals about the quiet component inside every long-term rate, the term premium. This unfolds in 4 stages. Stage 1 is liquidity expansion. Central bank credibility is treated as unlimited, and the risk of holding long bonds is priced as if the future is stable. Stage 2 is narrative concentration. Capital crowds into a single promise, reserve safety, and every institution that depends on long-term rates begins to build plans around that promise. Stage 3 is term premium repricing. The story stays the same, but the buyers change, and the extra yield demanded for uncertainty starts to rise. Stage 4 is household transmission. Mortgages, rents, and refinancing costs absorb the repricing, and the economy is forced to adjust in the most personal place possible: monthly payments. This is not prediction. This is pattern recognition from a century of modern sovereign bond cycles, where the sequence varies in speed but not in order. When the term premium is suppressed, almost any level of debt can be carried. When the term premium resets, the same debt becomes heavier without changing by a single dollar. The reason this matters in 2026 is that the term premium is no longer a rounding error. As of February 12, 2026, the San Francisco Federal Reserve's yield decomposition estimates the 10-year Treasury term premium at 1.16 percentage points, meaning a large share of the 10-year yield is no longer expected policy, but compensation for risk. That is the hidden lever. And it is the lever that touches mortgages, even when the Federal Reserve is not hiking. In Stage 1, liquidity expansion is usually sold as stability. After crisis, central banks buy duration, volatility is compressed, and investors learn to treat long rates as engineered outcomes rather than market prices. The public doesn't see term premium compression. The public sees lower mortgage rates, rising home prices, and refinancing booms that feel like prosperity. Then Stage 2 arrives, and the narrative hardens. The reserve currency is treated as permanent. Foreign reserves are recycled into sovereign debt. Private capital imitates that behavior because nothing is more profitable than copying the definition of safe. Now history becomes useful, because this sequence has already happened, repeatedly, whenever an imperial balance sheet meets the limits of global trust. Consider Britain after the Second World War. By the mid-1940s, government debt had reached levels described as over 250% of GDP. And the pound's global role had become a promise that required constant defense. In September 1949, that defense failed. Sterling is devalued on September 18, 1949 by 30.5%, moving from $4.04 per pound to $2.80. It is not a gentle adjustment. It is a signal that the cost of financing the system is changing, even if the institutions insist the system itself is intact. Over 19 countries are pegged to sterling, and they devalue alongside it. That is what reserve retreat looks like in real time. Not one event, but a chain reaction across the perimeter of an empire's monetary network. In the language of the 4 stages, Britain has moved into Stage 3. The narrative remains: Britain is still Britain, but the term premium demanded for holding its promise begins to rise, and the currency absorbs the loss of confidence first. The next chapter arrives 18 years later, and the pattern tightens. On November 18, 1967, sterling is devalued again, 14.3%, from $2.80 to $2.40. In the same announcement, the Bank of England raises its discount rate from 6.5% to 8%. This is the key detail that repeats across history. Once confidence breaks, the price of time increases. And the ripple does not stay in London. Within days, the Federal Reserve approves discount rate increases across multiple reserve banks, moving the U.S. discount rate to 4.5% from 4%. Major commercial banks respond by raising prime lending rates to 6% from 5.5%. The same pattern, same stages, same outcome. The timeline differs, but the sequence remains. Strain appears, term premium rises, and private borrowing costs are pulled upward by a sovereign problem. Now move forward to the modern bond era, where the machinery is even clearer. In September 2012, the Federal Reserve announces open-ended purchases of agency mortgage-backed securities at a pace of $40 billion per month. This is stage one in its purest form. The state absorbs duration risk, and the term premium is pressed down by force. But in May 2013, on May 22nd, Chairman Ben Bernanke testifies about the possibility of scaling back those purchases. No policy change has occurred yet. The balance sheet is still expanding, and yet the market reacts as if gravity has been reintroduced. The 10-year Treasury yield jumps from roughly 1.66% at the beginning of May to about 3.04% by the end of 2013. Mortgage rates respond immediately. By late August 2013, the 30-year fixed mortgage rate is quoted around 4.51%. That is stage 3 translating into stage 4. A repricing of time becomes a repricing of shelter. 3 systems, 3 eras, a single sequence: liquidity expansion, narrative concentration, term premium repricing, household transmission. Now the present day begins to look less like chaos and more like a recognizable point on the cycle. Right now, today, as of February 16, 2026, the United States is running a fiscal trajectory the Congressional Budget Office describes as worsening, with annual deficits projected near $1.9 trillion for 2026. Gross federal debt is described around $38.6 trillion, and the baseline projects continued upward pressure over the next decade. At the same time, the Treasury is not slowing its need for market funding. For the January to March 2026 quarter, Treasury estimates privately held net marketable borrowing of $574 billion, with an assumed end-of-quarter cash balance in the hundreds of billions. This is the supply side of the term premium, and then the demand side shifts. Official U.S. Treasury data shows mainland China holding $682.6 billion in Treasury securities at the end of November 2025. The same table shows total foreign holdings at roughly $9.355 trillion. This is not a world where foreigners have disappeared. It is a world where the identity, motives, and constraints of the foreign buyer are changing. Meanwhile, the largest pools of private capital are positioned to survive, not to subsidize. BlackRock manages roughly $14 trillion in assets as of December 31, 2025. That scale does not create loyalty to any single maturity. It creates sensitivity to volatility, liquidity, and collateral rules. This is why the headline about China is not just geopolitical theater. It is a signal about marginal demand at the longest end of the curve. And when marginal demand weakens, the term premium is where the adjustment hides until it suddenly doesn't. The San Francisco Fed's February 12, 2026 decomposition estimates a 10-year Treasury yield of 4.18%. In that estimate, the average expected overnight rate over the next decade is around 3.02%, while the term premium is 1.16%. That 1.16 is not a policy rate. It is the market's price for uncertainty, inflation risk, fiscal risk, and the risk that the buyer base becomes less predictable. This is why rate cuts can coexist with stubborn long rates. The front end can fall, the term premium can rise, and households feel the long end, not the headline. Freddie Mac reports the average 30-year fixed mortgage rate at 6.09% as of February 12, 2026. The 15-year fixed rate is reported at 5.44%. For a household, this is not an abstraction. This is the difference between qualifying and not qualifying. This is the difference between moving and staying locked in place. If you are between 25 and 45, Trying to buy a first home or refinance a starter home into a long-term plan, the term premium decides the ceiling on what you can afford. If you are near retirement, the term premium decides whether a bond ladder feels like safety or a trap that resets at the worst moment. Some will argue that China stepping back is not decisive. The bond market is deep and other buyers exist. That is true, and it is also incomplete. Because the issue is not one buyer. The issue is the stage of the cycle where buyers demand to be paid for risks they previously ignored. When the term premium rises, it does not ask permission. It does not require panic. It only requires a slow shift from automatic buying to conditional buying. Over the next 12 to 24 months, the pattern implies 3 warning signs worth watching. The first is persistence. If term premium estimates remain elevated, near or above 1 percentage point, then mortgage rates can stay high even in a slowing economy, because the long end refuses to relax. The second is auction behavior. When supply is heavy and demand is cautious, auctions begin to clear at higher yields, and the cost of funding drifts upward in small increments that compound over quarters. The third is spread pressure in housing finance. If Treasury volatility rises or investors demand more compensation, mortgage-backed securities require wider spreads, and mortgage rates remain sticky even when Treasury yields drift sideways. This is not fear. This is preparation based on historical precedent. The pattern does not guarantee a single outcome. It guarantees that the cost of time becomes the battlefield when confidence in the marginal buyer changes. Now the core thesis becomes simple. China's regulator signal is not the event. It is the confirmation that Stage 3 is active. Term premium is being repriced, and housing finance is being pulled into the adjustment. You have a choice. Understand the 4-stage cycle and position your decisions around what long rates are actually pricing, or ignore it and hope the term premium returns to the old world. If this analysis changed how you see treasuries, mortgages, and the geopolitics inside your monthly payment, subscribe now. In my next video, the exact auction signals, balance sheet constraints, and mortgage spread metrics to track will be mapped to a single dashboard, so you can see the shift before it shows up in your rate quote. The term premium reset is not coming. It is already here.